Today on the show, I have the pleasure of speaking with a very, very good friend of mine, Jonathan Twombly. Jonathan is a former Wall Street lawyer who became a multifamily syndicator and investor in 2011. He built a solid multifamily portfolio in the Carolinas, and he since has sold that. And he's also now co-GP'd and JV'd on multifamily deals in excess of over $200,000. He recently purchased his first hotel property with a view to build, what's called a boutique brand. And we're going to talk a lot more about this on today's show. And his company is called Two Bridges Asset Management LLC. And he's most passionate about being an entrepreneur, not working for anyone else, and helping others realize that same potential. Jonathan, welcome to the show. How are you doing today, mate?
I'm doing great. You missed 3 zeros on the amount of money that I've been the deals I've been involved with, but that's okay.
What did I say?
You said 200,000.
I meant to say $200 million. $200 million. If you're 200,000, I've known you for 8 years. If it's $200,000 in 8 years, I think someone's doing something wrong, right? But at least the beauty about podcasting is we can do whatever the hell we want, and people get to listen to it. But mate, how you been? What's been happening?
I've been really well. Well, let's see. I mean, as you know, we're working together on some deals, which is super fun. I mean, it's great after all these years of knowing each other to actually work together on stuff. So, really enjoying that a lot, and learning a lot from the way your process too, which is fantastic. Let's see. The big interesting news for me, I guess, is that I recently bought my first hotel,
right.
And that's a departure from what I had been doing before. But something that is a little bit of a passion project for me, but I also can't help with my entrepreneurial brain thinking about how this could, potentially grow into something big. So that's what's keeping me busy, other than helping you out these days.
Well, I want to get into that, but before we do, I want to rewind the clock and just reintroduce yourself to the people of Investing Nation here, because you were on my show way back in episode, I think it was 20 or 21. Mm-hmm. We're now at 360 episodes, 7 years later. So back then we were talking about how you're starting a fund, and I highly recommend everyone go back and listen to that. But just let's give us a quick introduction for yourself, your background, how you got into the space, just for those people who don't know who you are. And that's pretty difficult these days with your social media presence.
I think there are probably a lot of people who still don't know who I am, but nevertheless, So as you mentioned in the intro, I started out as a Wall Street lawyer. I did that for about 12 years altogether. The last part of my career was actually in real estate related law. I was on the litigation side. Most people who make the jump from law are on the transactional side. I was actually a litigator, but what I was doing was representing, ironically enough, hotel owners who were fighting with hotel chains. So, we'd represent the owners of major flagged hotels in, around the country when they were in disputes with the management companies or the franchise companies. So, I did that for the last few years of my career, but really got burned out with law. I got downsized in the Great Recession, or sort of immediately after it. And by that point, I was done. I mean, I remember actually thinking hey, how am I supposed to go get another job when I don't want the job? How am I supposed to interview for jobs I don't want? And I realized at that point, I really needed to make a change. I started doing a lot of networking in real estate because I'd become interested in real estate and, wanting to become a principal rather than, be a hired gun. As I was networking, I was kind of getting some mixed messages from people, one of which was, look, buddy, at your age, you're not going to get a job in real estate. Nobody's going to want to hire you. You have a great resume, but you're too old. We're talking about institutional, real estate companies. The only way you're going to break into this business is if somebody takes a liking to you and wants to be your partner. And that's exactly what happened. I met somebody who was putting together what I later learned was a syndication business. I had no idea what syndication was, but, we met. She was like, hey, I think you have the ability to raise money. And why don't we partner up? And so I just sort of jumped in, we partnered up. I did successfully raise money, but we had trouble closing deals. Back in those days, it was a, lender issue, really. We had deals under contract. we had the equity lined up, and the banks were the problem. We found banks didn't want to lend on this stuff, right? So that lasted a couple of years. Then we broke up after a couple of years of kind of banging our heads against the wall. Went out on my own in 2013, founded Two Bridges, and that was when I started getting some traction and started building that portfolio in the Carolinas.
And that's interesting that you've come through a breakup and sort of, I didn't realize you came through a breakup early on. Mm-hmm. How was that like? Because obviously you would start something coming out of law, all gun ho and found someone, let's get into bed. How was that coming out of that partnership?
Well, coming out of it, yeah, I mean, so I've seen other people do this. And now, when I'm talking with coaching students or talking with people in general, like I always say, you really need to partner in this business, but you shouldn't partner too fast, right? Do some deals with somebody first. There's no reason to jump into a partnership. But what you see a lot, and what I did was like, two people, you're interested in the same thing. Like you say, well, let's become partners. And what you think that means is, okay, now we have to form a partnership. And I think probably part of the reason people do that is because it feels like you're doing something productive, right? Even though like getting deals is really hard and getting money is really hard when you're starting out, but forming a partnership, well, wow, like we accomplished something. So, we sort of jumped into it. And then after we jumped into it and we had like formed an entity and gotten our operating agreement together and we're looking for deals, then we started noticing like the differences of opinion and like the differences of approach. And, she's having conversations with, certain people who are telling her this is how it's done. And I kind of viewed her as the expert, and because she had been in the business a bit. And then I was going out talking to investors, kind of using what she was telling me, and people were looking at me like, that's not the way this works, right? So we just wound up having differences of opinion. And we never really had any kind of like fight or bad blood, but there came a point where after we lost the few deals that we got under contract, that we kind of both came to the realization at the same moment that like, maybe this is a good time to kind of just break up. And so we just, fortunately we didn't have any assets that we had to like fight over. Nobody had to buy each other out. Like we kind of didn't have anything. We just had a couple of years of time kind of burned into this. And so it was a pretty easy, split.
But also help you set up yourself for success in what you wanted in life, right? Because I think clarity coming out of partnerships helps you define clarity and where you want to go, right? And I've seen you grow, and that's probably around the time we met. As you came out of that partnership, I remember having a beer with you in Brooklyn and talking about the mastermind we've started. But did that help you gain clarity to what you want to do?
It did. And the other thing that it actually did was I got a lot of learning and experience out of that partnership, even though we didn't successfully conclude any deals. I mean, we went right up to closing basically on a couple of deals, went through due diligence, went through the whole lending due diligence process, went through, interviewing management companies. I mean, really the whole setting up syndication. We did everything except close those deals. And what happened was, I took all the losses myself. I funded all this myself. I didn't use investor money. So my investors, who were all set up and ready to go, they didn't suffer anything except kind of having this money set aside for a while that then they didn't use, and they went and used it for something else, right? So that actually gave me a lot of credibility with my investors, who then when I went out on it was actually one of my investors who then helped me form my second partnership. When I sat down with him and I was like, gosh, I don't know what I'm going to do now. I might have to go back into law. And he was like, don't do that. Why don't we become partners instead? And I'll back you in this. It had to do because I essentially learned on my own dime, right? I spent 2 years, I got the education instead of, going to like a real estate program and paying some professors to teach it to me. I learned it on my own, at my own expense, lost my own money, didn't lose investor money. And I think that actually, even though it was really painful at the time, it came across making me look very credible to my investors. And also they recognized the experience that I had gained as well. So by the time then I did get deals under contract, they were ready to go. and invest in those deals with me because they saw what came before, you know.
Right. Yeah, you'd laid the path for success in the future based on some pain that you had to go through, which is a really interesting point and something that I think a lot of entrepreneurs need to go through to earn your stripes, right? Because that's how you prove to your investors that you're worth your salt. So, so from there, you then went on to buy deals in the Carolinas, actually in the market where we are partnering on a deal right now. Yep. And I have a lot of thanks to you for introducing me some incredible partners down there. But what was the landscape like? Because you mentioned lending back in the day. People weren't lending on multifamily. Is that a hang up of the 2008? Was that just like people didn't understand syndication and like, what the hell are you doing buying
No, it
property?
wasn't. It was a hangover. It was probably a combination of two things. So one was that it was absolutely a hangover of 2008. The lenders were still skittish. Those deals that fell through, this is 2011, 2012 timeframe.
Okay. Got it.
Right. The other thing I think was the market that we were in, which was Louisiana, which lenders were also like, they were, if they were going to lend on stuff, they were going to lend on like New York, LA, Chicago, Miami, that what we used to call the big six. Right. Mm-hmm. And Louisiana was just like too far, a bridge too far for them. Now, maybe if we'd gone with a local lender, that would have been different, but we were trying to get agency debt. We actually did get agency debt, even though it was our first deal, which is kind of amazing until they backed out on us, right? Mm-hmm. Until they then came up with some like crazy pretext for backing out of the deal, right? Somebody got skittish along the way about these properties that we were in contract for. So that was what, but now it's hard to imagine that happening now, or at least the last few years when lenders, if you just, if the word began with an M and ended with a Y, right? They were like, yeah, we'll give you money. Yeah. How much do you need?
120%.
Yeah. So it was a very different environment. Right. But then I switched, the only reason I was in that market was because she already had assets there. She knew that market. I was never particularly interested in that market, but I figured we've already got some headway made there. But I was interested in South Carolina because as you know, I like data. I'm kind of geeky. I can sit there. I can literally read census data for fun, right? I mean, I think it's fun. And I was just looking, I had a couple of criteria for when I started out because I didn't even know what I didn't know then, but I could sort of intuit a couple things. One was that population growth was better than not population growth, right? And the more population growth there was, the better. So now that if you said, well, what's growing? Well, there were a lot of places that were growing, right? So I said, well, okay, then it should be more than the national average. So that narrowed down the number of markets. And then I was like, going to Louisiana was a big pain in the neck from New York City. So it's got to be on the East Coast, right? So what's growing faster than the national average and is on the East Coast? Well, it was the Carolinas. Florida also fit that metric, but probably people will find this hard to believe now too. But Florida, a decade ago, had this reputation of being incredibly boomy and busty, right? So you could get caught with your pants down because they would overbuild in Florida. And coming out of the Great Recession, when overbuilding was this huge problem, I was like, I don't think I want to be touching Florida because who knows what's going to happen. That's crazy. So. But the Carolinas were really under the radar. They weren't boomy and busty. They didn't get overbuilt, but they had this really nice population growth going on. And I thought, that sounds kind of that's a little Goldilocks-y for me. Not too hot, not too cold. It's just right, So that was what attracted me to the Carolinas. And first, I was looking at Charleston, but Charleston even then was quite expensive at very compressed cap rates. But then I sort of discovered Greenville in the upstate, and I was like, wow. The population growth here is actually better than Charleston, right? And this is a really growing area, and it's really under the radar. Nobody was looking at Greenville in those days, and the number of sort of out of state investor groups at that point, there were 5 of us. We all knew who the others were, and they were all based in New York and Philadelphia, and so. It was pretty easy to get deals. And, you're buying deals at 8, 9 caps. And, and meanwhile, everybody was flooding into Texas. Texas was great because it was sucking all that investor attention away from the Carolinas. So I was able to get in when it was still, an under the radar place.
Yeah, well, and today we're getting under the radar. What does under the radar even look like today? So it's really interesting. But now let's pivot to your hotel. Like you've just bought a hotel. Maybe like explain why the hotel route. A lot of people in the multifamily space would think self-storage is the next, or mobile home parks would be the next sort of natural step. But you jumped to hotels, which if you look at the spectrum, and I work for a big developer, hotels would be up there in the sort of more risky category in commercial. You've got multi, you've got self-storage, you've got mobile home parks, you've got office, you've got retail, and you've got hotels. And we know coming out of the pandemic, people couldn't travel, right? So who's getting raked over the coals? So why the decision to go down the hotel route?
Yeah. So, this is, I can't say that this was like a planned out decision, right? Mm-hmm. It was not like, okay, I'm looking at the landscape and multifamily is crowded, so where should I go next? It didn't come about that way. The way it came about was, so my family, we own a second house in upstate New York in a region called the Finger Lakes, which is, it's a really beautiful area. Cornell University is in the Finger Lakes. But there are 10 lakes. They're long and skinny. That's why they call them the Finger Lakes. And, it's a wine region. It's becoming increasingly a beer region, spirits, farm to table food, ecotourism. There's beautiful waterfalls, and there's, the lakes are gorgeous and they're full of beaches and stuff. So we've been going there for years, and we finally bought a house a couple of years ago. And on the way to our house, we would pass this hotel, right? And the hotel was in this spectacular location overlooking Seneca Lake, which is one of the biggest lakes there. Just commanding view of this lake, right? And it was kind of this old, kind of tired hotel. And every time we passed it, we would say, wow, it's such a shame that there's this old, tired hotel in this amazing location. So fast forward a couple of years, I was on Crexy looking for maybe small. I was just thinking, maybe I'll try to pick up some small multis on my own in upstate New York, just because, again, I have that like want to look under the radar kind of bent to me, the value investor bent to me. Like I want to go where other people are not looking. And I was thinking like, there's some good markets up here. They don't have the growth that you have in the South, but there's some very solidly, economically solid places. The cap rates are better. Maybe could I fill a 10 unit property? Yeah, probably I could. I wouldn't really worry too much about being able to fill 10 units. So I was looking at stuff like that just to see what was around. And I noticed that this hotel was for sale. And so I was like, okay, that's interesting. And I noticed that it had been on the market for like a year, and they kept on cutting the price and cutting the price and cutting the price. So I just started playing around with it. And as I played around with it, I realized that, well, hey, I don't really know how to underwrite this. I don't know anything about hotels. Maybe I should find someone who does. So I talked with one of my business partners, just happened to ask him, hey, do you happen to know anybody who's in the hotel business who could give me some advice? And he said, look, my wife's cousin actually owns a hotel management company. He's a second generation hotel guy. Talk with him. So we started talking, showed him the asset, had him underwrite it. And he was like, I think there's something here. So we just kept on sort of digging into it. The idea being that we were going to rehab it. We're going to transform it into something, other than what it is, and, position it in the market differently and stuff like that. And as we got further down this road, the project became more and more appealing. So I decided to go to a couple of investors that, very old friends of mine who've invested in past deals, who have done, I did very well for in past deals, and just said to them, what do you think about this? I said, I didn't want to deal with a bank. I was like, I want to do this all cash, including, purchase price and rehab. And, what do you think? And they looked at the underwriting and they said, okay, based on your track record and our history together and what you're presenting, we'll do it. So I had everything lined up and figured, okay, let's go for it. So, interrupt me anytime you want.
No, this is great. Like, yeah. I think the one thing I want to, it's interesting as we all grow as an entrepreneurs, right? I have that I don't know if it's fantasy or the lust when you're in a place and it's a holiday where it's like, oh, how cool would it be to own that over there? You know, I want to own that building driving. I always remember the Flatiron building in New York City just being completely in awe of how it's just such beautiful architecture. You're like, oh, I'd never own that, but you always dream. Yeah. But it's awesome that you drove past it, and it's a bit of kismet that's come all around to say, like, now you've got this thing under contract. So let's dive into a little bit more of the numbers here. So what from a high level, you mentioned growth before in markets. What do you look for in hotels to make sure that you're, are buying something? Because hotels are, inherently for vacations and when people have excess money and all that sort of stuff. So how do you get comfortable knowing a region's going to sustain its sort of appeal?
Yeah, it's a good question. And it's definitely sort of a thought process I went through in respect to this hotel, right? So, so one thing I knew was I'm going in at a pretty low basis, right? And if we have time, we can talk about sort of where I want to go with this and some thoughts around the hotel business. But we're going in at a low basis, so that took care of some of the risk right there. But there are some other appealing things about this particular hotel, right? So, and this market. One was that this region in general, the tourism industry has been growing steadily over time, right? So the Finger Lakes have become more and more of a destination for people all over, really like the eastern half of the United States and into Canada. I mean, this is 2 hours from 2 hours from Toronto, right? So you have a lot of people coming from Canada to the region. The Finger Lakes is probably the premier wine region on the East Coast, right? New York is now actually the third biggest or maybe the second biggest wine producing state in the country. So
it'd be like a Sonoma Valley type.
It is, yes. So it is definitely trending in that direction in terms of like a Sonoma. It's adding, like I said, there's now a big craft beer industry growing there, a big, spirits industry growing there, cheese, farming, farm to table, plus the nature, which draws in a lot of people. The second thing, so regionally you have that, right? But with respect to this specific hotel, there's also a state park called Watkins Glen State Park, which is pretty much every year ranked one of the top 5 state parks in the country. And it draws about 1 million people a year to the state park, which is surprising because it's a very small park. But the thing is, if you have ever seen like the Lord of the Rings movies, and you see the Rivendell where the elves live, that's basically what it looks like. It's a spectacular, canyon that you can hike through and hike behind waterfalls, and it's got like 11 waterfalls in this canyon, and it's just amazing. So that draws a lot of people. There's also the history of Watkins Glen. It's a big auto racing area, and they literally used to have Formula One Grand Prix through the streets of the town in the 50s, and now they have NASCAR, but there was Watkins Glen International, which back in the days when Formula One was popular in the US, that Watkins Glen was one of the main Formula One ventures. And interestingly enough, this hotel was the kind of preferred place for the racers to stay. So you had Paul Newman always stayed at this hotel when he was racing. Mario Andretti always stayed at this hotel. And so it's got this amazing history too, which we don't want to try to play on a bit as well. But I knew just from the, like, what's the draw of this? We knew we had the draw. We knew people were coming, and we knew that the region is growing and people are going to continue to come. And then the third thing was that, other than being shut down completely, because when the shutdown orders in COVID happened, once things opened up, the place boomed because people went, like, they couldn't fly anywhere, and they had to take driving vacations, and the region just boomed the last couple of years as soon as things opened up, which meant that there are millions of people who had never been there before who've now been there, and chances are they're going to want to come back again because now they know the region, right? So it was a big boost to the region in terms of tourism. And if you think about where it's positioned, you're basically within a 4 or 5 hour drive of New York City, Philadelphia, Toronto, Pittsburgh, Ohio, like Boston, maybe 6 hours from Boston, but the whole Northeast Metroplex, you're within a quick drive of this place. So for a driving vacation, you've got, 30, 40 million people within driving distance of this place, and multiple attractions. So it's not just the waterfalls, not just the racing, not just the wine, not just the lakes, but all of it together. So that was the thinking behind it.
No, and I think that to your point of coming out of COVID, again, all the kismet nature of this investment, it's COVID forced people to be more into the driving. So probably people wanted to escape for weekends and couldn't get on planes to go internationally. But from an underwriting point of view, how do you underwrite it in differences compared to multifamily? I know just my little bit of knowledge, ADR, average daily rate, for those people who don't know what that means. Maybe explain like a little bit of the ADRs and the occupancies and how you're looking to make sure you're saying you're buying at a good basis, but how are you then from a stabilization point of view, what are you looking at to really make sure you are remaining conservative and you can hit your numbers?
So the first major difference in the underwriting that jumped out at me when I started, working on it with my manager that I've hired is that, like in multifamily, you're looking for, you're shooting for like a 50% expense ratio, right? Mm-hmm. Generally speaking, so 45 to 55. Maybe if you've got a Class A asset, you can be below 40, right? Because you have less, ongoing maintenance and stuff. But also in multifamily, your expense costs are mostly fixed, right? Maybe you can like get away with one less staff member or something to kind of shave the expenses, but there's not. You can institute rubs maybe to get your utilities costs down or whatever, but it's basically fixed, right? I mean, the only variable that's really going to change with occupancy is maybe utilities because people are using more or less utilities. Hospitality is very different. Your costs are basically a function of your occupancy, right? So the more occupancy you have, the more cost you have, and generally what you're shooting for is about a 65% expense ratio. Right.
Wow. Okay.
But it's directly connected to your occupancy, right? So because let's say your front desk staff, your especially your housekeeping are directly related. They're paid by the hour and they're working more or less hours depending on whether you've more or less guests, right? So that cost expands or contracts with your occupancy, right? Same thing as like, a major expense for hotels is credit card charges, right? Mm-hmm. That's directly related to how much revenue you're bringing in, right? So you don't have as much, fixed costs. Your fixed costs are going to be your property taxes, if you have a mortgage, your mortgage, right? I mean, even utilities to some extent are going to be related to how many people are in the room turning on the lights and turning on the heat, right? So it's a different way of looking at it. And, when I first thought like, 65%, that's too high. Well, that's just basically, that's the industry standard. That's what you underwrite. Mm-hmm. Maybe you'll be able to shave a couple points off it here or there, or maybe if you can really get premium room rates, you can expand it a bit more, but you're kind of like shooting in that range, right? Yep. So that was one big difference. And the other is that, sort of looking at like a hotel like this is very seasonal, right? So you've got, summertime, you're packed out, and then you've got what's called head and shoulders, right? So the head is the summer, and then spring and fall are the shoulders, and then it sort of drops off in the wintertime, mm-hmm. right? And so you sort of writing conservatively, you're trying to figure out, well, what is my occupancy going to be for like the whole year? Right. And we shot pretty low on that number. We thought, okay, we're probably, all things considered, being near 100% in the summer and being probably, 15 to 30% in the wintertime.
Wow.
We're probably going to be around 56, 57% on an annual basis, right? Mm-hmm, so mm-hmm. You underwrite that, and then you figure out what you think you can get, right? And that's your rate, right? And then you multiply by your occupancy, you get your average daily rate. So that's how you underwrite it, right? You basically use those two variables, like what are we going to charge for the room, and then what do we think the average that we're going to get for the whole year is, and then what's our occupancy? So that gives you your top line revenue. Yep. But then there are other things that you can do, which for instance, we are not being done at the hotel. So I could take a break now too if you want, but there are certain things that were some quote unquote value adds that, in addition to the rehab that we're going to do, there are value adds that we're able to put in place, that allow us to capture more revenue. But I don't know if you have a question now.
And for those people listening, again, I used to work for a hotel developer actually, and they call them a PIP project. What is it? A project? What does PIP stand for again? It was like it's essentially value adds. You come in and you performance enhancing program or something like that. That was what it stood for.
Those are when the flags come and tell you have to go and you have to
build a certain way.
You have to do your whole hotel over again with our new brand standards, and you got to buy new mattresses and new linens and new desks and new beds and new everything. Yeah.
But from a design point of view, it's like they've got a whole thick book. If you went to Hyatt or you went to, Hilton, they would be like, depending on the flag, you would have to, have certain look in your lobbies and certain looks in your in your room. So for you, you're boutique, right? So you can really do whatever you want, right? Is there pros and cons for being with a flag and not a flag?
Well, yeah. So and this, it's funny, in a way I've come full circle because I was a hotel litigator, right? So back in the day, so I was familiar, you were familiar with this from the building side. I was familiar with like these brand standards and stuff from the litigation side where, the brands were like forcing owners to spend all this money that they didn't want to spend, and they were always fighting about it. But the advantage to having a flag, right, is supposedly the reservation system and the brand. Like you don't have to do any of the work of brand building. You're just buying into a system that already exists. That's the argument, right? And for a lot of, if you're building hotels, it's almost impossible to build a hotel without a flag because the lenders really only lend on flagged hotels, right? Because it gives them that
risk.
Right. Yeah. They see that as being less risky than building an independent hotel on your own. So those are the two big advantages. The disadvantages are like what you said. You now have to build the hotel the way they want it, right? And it kind of locks you in because if you decide you want to go from like Marriott to Hyatt, right? You've now got to go and basically redo everything in your hotel to bring it to the Hyatt standard instead of the Marriott standard, right? Or when Marriott decides that they're changing all of their corporate logos and branding, well, now you've got to spend all this money to redo everything in your hotel to accommodate them. As an independent, we were just, before this call, I was on, I had two calls this morning, one with our branding people and one with our design team. And, a couple of weeks ago at the hotel, I met with the design team, and the question I asked them was, well, how quickly can you turn this around? And they said, well, because you're an independent hotel, we can turn it around very quickly because we don't have to then go to the brand and spend 2 months
back and forth
with them, after, and then the back and forth with you about getting, so the process is much more streamlined because we don't have to answer to the brand. Right. So that's, we have just much more freedom to kind of make our own aesthetic choices, make our own choices about kind of the quality of, bedding, linen, amenities, whatever we want to do. So there's a big advantage in some ways to having a non-branded hotel because you have that freedom.
Yeah, no, and I would love to spend more time talking about this. We do actually have only a couple more minutes left in the show, but really, what's the goal here of producing something bigger than you? I mentioned in the introduction something about a boutique line of hotels. Is that the thought, given your entrepreneurial brain?
Yeah, so this is definitely one thing that I'm trying to just do one step at a time. Let's get this one done, make it a success, and then think about expanding. But since the possibility is there, when we're picking names, we're trying to think about, well, what's brandable, what's not limited to this location, what's something we can take to other locations if we buy more hotels. I think there's a great opportunity in this space because if you look at sort of who owns these hotels, it's a little bit like multifamily was a few years ago, where you had a lot of mom and pop owners, right? And they were semi-professionalized at best, and they're it was before the big institutions getting into buying from mom and pops, right? If you look at a lot of these hotels, well, who owns them? they're baby boomers, sometimes even silent generation folks are older than the boomers. Their kids don't want to take over the hotels, right? And there's a very limited exit for them because you basically have to sell to somebody who wants to then take on the job of running a hotel. And, when you get into if it's a bed and breakfast, I think most people can probably handle like a small bed and breakfast if they've never done it before. Mm-hmm. But getting into like a 30, 40, 50 room hotel, that's like, if you don't have some expertise, this is difficult, right? And plus you've got to come up with the capital. I think that there's a lot of opportunity to buy these hotels at reasonable valuations. They almost all need some work because the nature of this business with these mom and pops is they just don't have a lot of additional capital to reinvest in redoing the hotels, right? So you see them, they're sort of, maybe they've been redone once 20, 30 years ago. They really need a refresh. And I think that the opportunity to come in, find more attractive assets in attractive locations. Once we've gone through all this work of like building our own design, sort of schematics, what our brand looks like, then it becomes very easy to go into the next one and do it the same way. We have the management lined up. We can just kind of create a system where we can buy these assets at decent valuations and then, professionalize the operation, redesign it, rehab it, make it into something new and nice, and just move on to the next one.
Yeah, I think the key there is with boutique hotels is finding those locations, right? If you start looking at certain, I know I travel a lot. I look at certain areas of, in Italy or parts of Mexico or parts of Australia, which have very, very beautiful hotels. And you would never see another brand like that until you get to another really exotic location, like in Greece or something like that. So is that kind of the thought that potentially will be around?
Yeah, I mean, what I'm thinking about is if we can find more things so we're going for, this is a 1950s hotel. So we're going for kind of like a retro mid-century modern Mad Men kind of feel, so wanting to be sort of cool, but also recognizing the fact that this is not Brooklyn, right? This is upstate New York. So kind of just trying to figure out how to kind of get that mix right. But there are lots of places like all throughout the Northeast, if we just want to start there, where you've got like lakeside hotels in very, the Adirondacks in New York would be like another logical place to go, or the Thousand Islands in New York, another sort of very similar kind of market. It's very, very, seasonal. There is some business the rest of the year, but mostly it's that kind of summer, spring and fall business. And you have very similar assets there. You have you can find places with the same kind of beautiful views, or, whether they're mountain views or, water views or whatever. I think this is replicable in other places around the Northeast. So you could build a brand around that sort of similarly situated, hotels that, in beautiful spots, where your competition. One thing I didn't mention too is sort of the positioning of this hotel, because in this market, there's one sort of quote unquote luxury hotel, which is kind of corporate-y, and then there's a lot of these kind of old mom and pop motels. So there's like a top and there's a bottom. And there's nothing in the middle. Mm-hmm. We're going for the middle, and I think that there are probably a lot of other markets that fit that same pattern, where you've got a couple of like your typical limited service, motel, hotel, your Hampton Inns and whatnot. And then you've got a bunch of kind of these tired old motels from the 50s, and maybe some like really high end, B&B or little tiny cute inn that's, $500 a night, but there's really nothing in the middle. Right. That's cool and unique. And I think that we can potentially fit that spot.
Yeah, no, and I completely agree. As a traveler myself, when I go on holidays, I don't want to stay in that corporate, chain, right? I want something unique, and boutique hotels offer that in beautiful locations. When I'm traveling in Austin or Greenville or, New York, you stay and just, okay, what's cheap? What's going to put somewhere to put my head? I think from a design perspective, from a boutique perspective, you've got to be a little different. But I think you play into that with a good design team and also choosing the right location. So, but mate, with that being said, we do like to wrap up the show here. Look, I want to thank you so much for jumping on the show. Where can people reach you if they want to continue the conversation? They want to be in your sphere? Where do they go?
Yeah. So, I say the place to go now is to apartmentinvestorsclub.com. That is sort of in the process of bringing all of my brands under apartmentinvestorsclub.com. So if you go there, you can get a free download and get on my list. That's probably the easiest way to get in touch. You can also always reach me at Two Bridges Asset Management if you're looking to invest in deals with me. And you can reach me at Twombly at Two Bridges Management, which is MGMT for management.com.
Awesome, mate. Well, look, I want to thank you so much for jumping on today's show. I just want to quickly reflect some of the things I took away from today's show. I think the first one is just knowing you for so many years, seeing how awesome you're coming into your own self and finding these little niches in and around the country and really reflecting of who you are as a person. I think that sort of it speaks volumes in terms of seeing something on the side of a road that you thought was cute and affordable and then going down that path, or well, not affordable, but cute, and we could do something with it, and then it's like slowly chipping away at it and finding out there's opportunity. And so having that resilience there, I think, is really, really important. And I think also understanding the hotel business in itself, it's a whole different asset class. It takes a different way of thinking. But by the sounds of it, you've got the right team around you. You're going in the right direction from a boutique point of view. You're trying to be different in a local market, but also being hyper local and understanding that local market because you and your family have a house up there. So all those elements come together to make this such an interesting conversation that I could continue talking to you for the next couple of hours, but I do have to jump to another call. But did I leave anything out?
No, I think that pretty much covers it. So awesome. I'm looking forward to coming back when this is all done and we can talk about it more. Yeah,
I'd love to see some drone footage of the before and afters. So, well, with that being said, mate, enjoy the rest of your week and we'll catch up very, very soon.
You too. Have a great weekend.
Well, there you have another cracking episode jam-packed with some incredible advice from Jonathan. If you do want to get into his world, go to apartmentinvestorsclub.com. Is that correct, Jonathan? Or apartments?
Apartment Investors Club.
apartmentinvestorsclub.com. Check that out. He's also on LinkedIn and on social media. So just Google his name, easiest way to find out. If you do like this show, the easiest way to give back is to give it a 5-star review on iTunes. And I want to thank you all again for taking some time out of your day to tune in to continue to grow your financial IQ. We're going to do it all again next week. So remember, be bold, be brave, and go give life a crack.